you have any questions or comments, ticker symbols, please feel free to throw those in our question and answer chat feature. We're, have the ability to be a little bit more flexible today. We don't have a set outline, so to speak. We have a general kind of, expectation in terms of topics we're going to cover, but we're happy to deviate if and that is something you want us to see, and if we have, again, some participation in that aspect. After showing some disclosures here, I left them up the screen for a couple seconds, so the compliance people should be happy. I'm going to navigate to fidelity.com, and I'm going to start our discussion today, just broadly speaking, talking about dividends. And then we're going to get a little bit more specific and more narrow in terms of what tools can you use, what are some caveats, some pros and cons of investing in dividends, and if you're invested in a company already, what are some metrics you can look at? What are some things you can look at? If you are evaluating a company to invest in that currently pays a dividend or has been growing its dividend, maybe it has a good track record, maybe it just started paying a dividend. There are a couple well-known companies that in the last year or so recently announced and started paying dividends. So what are some things we can think about relating to that topic? So if you're on fidelity.com, let's get started here. The news and research tab, really encourage you, if you haven't checked it out already, the Learning Center is a really great area with a lot of different types of resources. You might think, okay, if I'm an experienced investor or trader, I don't really need it. I would say I use it a lot. And if you are experienced, if you are brand new, I think it's going to be helpful for you, even, depending on what type of the experience spectrum you fall on. So in terms of beginning our discussion on dividends, what I'm going to do is I'm going to go into topics. And we know here, just a shameless plug here, if you go into events, this is where you'll see a lot of our other content. If you're joining us today for the first time, maybe you're not a regular attendee, we do have things like daily market briefings, we have coaching sessions, we have regular monthly classes that cover kind of these foundational aspects of trading, like technical analysis, options investing, options trading, et cetera, et cetera. So let's go into topics. And what are we talking about today? We're talking about stocks. We're talking about dividends. So let's go into investment products, and then let's go into stocks. And what's really interesting, if you go here, there's a lot of different articles and topics relating to stock investing, and there's actually a whole section about dividends. There's a video and there's two different articles. This does get updated from time to time. I believe there actually was some more articles here that I think might have been shifted or might be outdated, so they might be getting edited, they might be getting rewritten. But I'm going to take a look at the Why Dividends Matter article, and I think it's going to, again, paint a nice broad picture for us in terms of what's the hubbub, what's the scuttlebutt with dividends, and why do we care? Why do they matter? So not every company pays a dividends. Not every investor cares about dividends. Dividends as an income stream tends to be a little bit more kind of suitable, kind of interesting from people who want income, from retirees. Perhaps somebody came into a lot of money very early on and says, hey, this could be a way for me to generate income on my assets. So there's a couple different types of investors or investor profiles that tend to be more interested with dividends or income. In the long term, I would say price appreciation is most of the total appreciation or total gains with stock market investing. And we can look at something like the Standard & Poor's index. You can look at a lot of other metrics. And in the long run, it looks like, for example, I looked at a older dated article of Standard & Poor's, and it said, and this was from, I think, the early 1920s until about 3 years ago or so. So it's a little bit dated, but it said something like dividends accounted for about a third of total market returns. So the idea is you're not going to invest in dividends for monster gains. You're really just not going to get that with dividends. There can be times where the market, has some headwinds. Think about calendar year 2022. It was a bear market. So for somebody who's investing for a longer period of time, there can be periods where price is not going to be your friend. It can potentially tuck in for a longer period of time. And so getting a consistent stream of income can be something that can add what's called ballast or moderation to a portfolio. There are some companies that have paid dividends for a long time. There are some companies, like I just said earlier, that have just started paying dividends. For example, there's a company, Procter and Gamble, that's paid dividends since 1891, right? So over 100 years of dividends there. So when we think about dividends, we want to think about, okay, I'm getting income on my current principal or investment. You could also think about it from a perspective of, okay, how long would it take for me to recoup my investment? I don't think that's what every investor kind of thinks about, but I think that's a maybe an interesting way of looking at that perspective. In this article, there's a cool thing called the dividend payback matrix. Again, don't spend a lot of time here. I think it's just interesting to kind of get the gears turning. But the idea is if we compare current yield with dividend growth rate, you can see how long it would take for you to generate a return just counting the dividends, we're ignoring price, that would actually recoup your whole initial investment, right? So, for example, if you get a 2% dividend yield, now you might say 2%, that doesn't sound too exciting, Troy. But let's say the company grows a dividend at an average rate of about 10%. That is a very fast dividend growth rate. Not every company is going to be doing that. But just to use an extreme example, okay, you would get your money back in about 19 years. And again, that's a long time for if you think about if you're investing in your maybe early 30s into retirement, maybe that's about a 30-year or so cycle. That's not even a full kind of length of time there. Now, if you think of a high dividend yield with no growth, maybe a company that pays about a 6% dividend yield. And you might be asking, Troy, come on, what companies actually pay a 6% yield? You'd be surprised. There's actually a number of them out there right now. We shouldn't look at necessarily a 6% yield and say, oh, it's risk-free money. It really isn't. There's going to be a lot of caveats we need to consider in terms of sustainability. Can a company pay that much and continue to pay that much without hurting their own coffers? And maybe we want to say, okay, company pays 6%, has 0% growth. It would take about 17 years to, get your money back. If you get no growth, low yield, maybe it takes a long time, about 50 years. That wouldn't be a surprise. Maybe you get the best of both worlds. You get a high dividend initial yield and a high growth rate. I think that would be very, very tough to really find. But in an extreme case where you get your cake and eat it too, you can see you would recoup your investment in actually a relatively short period of time. Now, there is a set relationship between price and yield. For those of you who have invested in bonds or you're familiar with bonds, we know that price and yield are inversely correlated. Price goes down, yield goes up. It's the same thing for stocks. If a company promises a set dividend, the yield is that dividend per year divided by your price. That's effectively how much you're getting for buying the each share of that company's stock. Now, if suddenly that yield starts going higher, that means all else equal, the price of the stock is going down. So if we're getting 4% dividend per year and our stock is losing 10% every year, it's not going to do us good if the stock doesn't bounce back because we're losing principal despite getting a recurring stream of income. Ideally, we want to protect our principal and get income too. There is sometimes, in terms of the mechanics of a dividend, there are some misunderstanding in terms of how it kind of works. So when a company pays a dividend, there's four main dates to consider. I would say two of these dates are of larger significance. I would say you want to keep all of these in mind in terms of just the mechanics. A company announces it's going to pay a dividend. That's called the declaration date. The board of directors says, hey, we've signed off and approved. The company's going to pay this dividend. There's going to be a record date and there's going to be a payable date. The X date is the too late date. If you buy a stock on the X date, you don't get that dividend. And what happens is, let's say you have a stock that's trading at $100 a share. Let's say it has a $1 quarterly dividend, so a 4% yield per year, right? What's going to happen is on that X date, the stock trades excluding the dividend, X the dividend. All else equal, you would expect the stock to trade now at $99 a share. And why does that make sense? Because cash is effectively leaving the company instantaneously. So the market is efficient in that it makes an instantaneous adjustment. If it didn't do that, it would be free money. You could just buy the stock and then sell it and then get, sell it for the same price and then get the dividend. Well, we know there's no free lunches in investing. Investing involves risk. Dividend investing is no different. It also involves risk. The risk is, okay, we're looking at the long-term valuation of a company. Okay, it's going to be adjusted instantaneously for that cash leaving. But at the end of the year, at the end of 5 years, what's the company worth? That instantaneous cash leaving the company is going to be a smaller kind of effect, so to speak, on the company's that overall valuation. So if a company is worth 50 billion, and if it pays, keeps paying a cash dividend, maybe in 5 years, it has a 10% growth and it's worth 55 billion. Well, depending on how that company has managed its stock program in terms of shares outstanding, you could see growth or appreciation on your underlying, on your principal, and you could get, potentially cash dividends as long as the company was able to sustain its promised stream of dividends. So the idea is dividend stocks are interesting as opposed to fixed income because the idea is, can I have principal growth and can I have income at the same time? With bonds, you only get growth if there's a decline in interest rates, which would make your bond worth more dollars since the income is fixed. Obviously, there's different types of bonds. There's different types of kind of instances when bonds might be attractive, but essentially bonds are a play on credit worthiness and then also interest rate sensitivity. Whereas with stocks, they're equity, they're different than bonds. They're not a debt instrument. You have an ownership interest as opposed to you are a creditor, right? So make sure you understand this. Not going to spend a great deal of time on the mechanics of a dividend, but I always like to say this because, again, some people have the idea that, oh, I'll just buy a stock, I'll wait for it to pay a dividend, and then I'll just sell it. It's not that simple. A stock is going to adjust just like any other stock intraday based on supply demand forces, based on any news, based on future expectation, discounting that into a perceived present value that the market perceives as being a fair value of that company's shares. So dividends tend to be something that are looked at from a longer term perspective. They're not something you do for a shorter term perspective. So I wanted to clear the air there in terms of just kind of some basic myths or mechanics there. But Jake, let me turn it over to you. We know a company can do a lot of things to add value to its to shareholders, right? They can pay out dividends, they can buy back stock, they can acquire other competitors or make other acquisitions. They can do a lot of things. So dividends are not the be all end all, but I think they can be an interesting way to again gain exposure to certain types of companies that are a little bit more stable. That stream of income could be of interest to us depending on if we are a retiree or at some stage in our life where we want some kind of a recurring stream of income. Perhaps you'd want to share some of your thoughts on dividends.
Yeah, this is an interesting idea, Troy. And so thanks for bringing it up. I hope everybody sees those four different dates there on the screen. Each of them is very important in its own right, but the one that's the most important for most people on a practical basis is the ex-dividend date. It's the one that matters because it's the one that says if you purchased prior to this date, you're going to get the dividend. If you buy it on this dividend or after, or if you sell your shares, you are selling or buying without dividend. X means without dividend. You buy it on that date or after, no dividend included. It's just the shares. And of course, any future dividends way out in the future, but not this current one. So as we understand that kind of play between the dividend and our own decisions, we should see that there is, like you said, Troy, no free lunch here. You can't buy this stock on February 7th and then turn around and sell it on February 8th, bring in that dividend and expect a profit. The only thing that's going to happen there is you're going to buy for, say, $50 per share. Then the shares go down by $1 because of the $1 dividend. You have to sell for $49, or maybe you sell for $49.10 or $49.25 or $48.50. Whatever up or down happens based upon market fluctuation. However, there are some interesting ideas long term based upon dividend focused investing, but usually they're, like you say, Troy, more on the long term scale. But let's go ahead and take a look and see how we could find some of these ideas and perhaps learn a few things together about them. There were a few gems you threw out there teasing the people here, Troy, that they would like some answers on. So one was, how can we find a list of these stocks that pay dividends or their yields? How can we find some of that? Let's start there. I'm going to go to fidelity.com and I'm going to come up here to the top corner of the screen. You can see we've got this green bar across the top, and right in the middle says news and research. This is where we're going to spend our time today. News and research. Then we're going to click on stocks. News and research, then stocks. This page gives us many different ideas that we can take a look at, but included here towards the top left is a link to our screener tools. We're going to go ahead and just click on that screener tools, and we can start a stock screen in this case, allowing us to filter from the thousands and thousands of stocks that exist out there to only identify those that meet our specific criteria. For example, if we notice over here on the left-hand side, we have many different criteria available from which to select. One of them is dividend yield, and let's go ahead and select dividend yield. And when we have done so, we notice that now in the middle, we have a column labeled dividend yield, but it's done no filtering or even sorting yet. All it did so far is added as a column. But if I was, for example, to say, I only want to look at those that have either very high or high dividends, well, now that's both filtered and sorted so that we're seeing those that have the highest currently. But do you notice something suspicious here, folks? Pine Valley Mining Corporation is promising to pay you a 2,000% return. Also, its security price is going for 1 penny apiece here, folks. Yes, this is too good to be true. And no, the company is actually not making any promise. A dividend yield is not a promise to pay. Remember that that's one of the big differences between a dividend and a bond. A dividend is income, but it's income that is declared, decided upon by the board of directors each and every quarter. And they can, with no consequences, evaporate that dividend. Say, no, we're just not going to pay it anymore. They could increase the dividend. They could decrease the dividend. They can choose to do what they will with the dividend each and every quarter. However, in this case, it appears Pine Valley Mining used to pay a dividend, and therefore there is a dividend yield. But as a stock worth only a penny, it would be unreasonable to expect they have much in the way of available capital to pay us over time. So even if we skip over this one with 2,000, a 100% return, that sounds a little suspicious. 80%, 60%, there is likely something going on that's driving these yields in a strange way. I would encourage you to caution before assuming these are opportunities for profit. So just as a way of screening this down, let me go ahead and limit our results here to only those stocks that fall between 3.5% and 20%. Even a 20% yield is very, very high, but let's include it here and see what this brings us down. Now we've got some that are starting to sound perhaps a little bit more reasonable, paying somewhere above 15% yield. That's still an impressive rate of return if indeed we could count upon it. But let's go ahead and take a look at some of the stocks that you have pointed out that pay a pretty nice dividend. There were several of you that seem to be aware of these that pay 6% dividends, like Troy mentioned. Yes, they exist, and some of you already found a few of them. Let's take a look at MO, BTI, HESM, PFE, and NOG. I'm stopping there. Those weren't all the ones that were sent in, but they are the first 5 that were sent in, and 5 is the most that we can add in here. But when we add those to our stock screener, I did that again by clicking on Add My Stocks. Then we're able to add a list, and it includes the same criteria, but it does warn us if by chance they don't meet our criteria. For example, we notice that Northern Oil and Gas is the lowest paying of these, and it pays 3.87. That's slightly above our 3.59, but let's suppose we changed our range to instead go from 4 to 20%. We notice that the one that we told it to include is still here, but it gives us this warning sign that says, I'll show it to you because you told me to show it to you. But just so you know, this doesn't meet your screening criteria. So be aware you are comparing apples and oranges to some degree. So if that makes sense, I hope we see where that's coming from. But now we've got quite a few on the board. And nonetheless, we see some that are still here. All 5 of these paying pretty decent dividends. Let's go ahead and take a look at that next idea. How are they paying us this money? I'm reminded from a quote from one of my favorite personal finance books, The Richest Man in Babylon. Has anybody in the audience read The Richest Man in Babylon? It's a favorite for me. I read it a couple times a year. This book tells us all about some interesting personal finance ideas, including an encouragement to save at least 10% of your income and other just generally wise advice. And though some of its examples rely upon age-old appropriate measures of slavery, which we'll go ahead and leave aside, I will tell you of one important example in which one of the wise individuals is speaking to somebody learning about money, in which they say instead, what are you doing with your income, the money that your money is earning? And this new individual to having money in their pocket says that I have a feast, that I spend that money, I have a nice dinner, I finally do something good for me. And the wise individual laughs and says that you eat the children of your savings. You're missing out here. Well, what's happening inside of these companies? Are these companies eating their own children of their earnings? Are they preventing those earnings from growing and growing and growing? The thing that made Amazon stand out and eventually become the large behemoth of a company that we know today is that Jeff Bezos and those that led the company along with him refused to pay out earnings or even to realize earnings, instead constantly reinvesting that money back into the company in order to amplify its growth over time, eventually resulting in the absolute titan of online retail sales that we know today. It has since turned a corner and has started generating earnings that can be realized, paying out some portion of those earnings over time. But let's take a look at how Altria, British American Tobacco, Hess Midstream, Pfizer, and these others on the list are dealing with that question. The easiest way for us to tell is to use a separate criteria. This one's called the dividend payout percent. Those of you who have done some financial analysis might know this as the payout ratio, or its antithesis is the earnings retention ratio, as we think about how much of its earnings did it keep versus how much did it pay out to shareholders. While these rates look pretty reasonable, especially when we know that there are some paying even higher, what do you notice about the dividend payout ratio? LQ stands for last quarter. As of last quarter, Altria paid out 82% of its earnings to you as a dividend holder. Are they leaving much of those earnings in the company to reinvest and grow? They're paying almost every penny of earnings out. In the case of Hess Midstream, they are not paying almost every penny. They paid every penny and more to you as an owner. Paying more than 100% means they actually dipped into their bank accounts, and instead of just paying out of earnings, they also sold off some cash, some investments. They limited the size of the business. What about Northern Oil and Gas? 345%? Does that sound sustainable? Likely not sustainable on a long-term basis. Now, there is some important things to note here. Number one, I will tell you that there is a difference between a pipeline like these two and a standard company like Pfizer, where in the way that they are both taxed and the way that they pass their taxes on to you. And so be aware that there is more to consider here. This hasn't given us the full conclusion, but it's at least a start at that idea of sustainability. Can a company reasonably do this? Perhaps and perhaps not. Let me go ahead and delete these ones that we have added. And let's take a look at, actually, maybe I'll just remove a couple of them, these bottom three. And let's add some other well-known securities that aren't necessarily well-known for their dividend. If we add on here Apple, Amazon, and Nvidia, Apple because it's the largest company in the world, Amazon because we've been talking about it, and Nvidia, here we notice that none of these three meet our dividend yield criteria. Apple pays a dividend, but it's only 0.5%. Amazon does not pay dividends, and Nvidia pays a 1 cent per share dividend, an almost nothing dividend. But as we take a look, now their dividend payout ratio is very, very different. They are paying out, in some cases, a small dividend, but they are keeping the rest of those earnings in the company in order to do other things with them. There is many other things a company could do with their earnings, but certainly we should be aware of that possibility that the company is actually dipping into their bank accounts, dwindling, the so-called slaughtering of the golden goose in order to pay you that dividend. Are we then putting ourselves at jeopardy of that dividend being sustainable over the long term? That's how you can start using the stock screener to understand a little bit more about how this works. In order for us to do so, perhaps I can show just one idea related to this as we dive in and take a look. Actually, you know what, Troy, it occurs to me, I think you are going to dive a little deeper onto individual stocks. So I will forestall here and go ahead and pass it back to you to dive us a little deeper into the individual stock ideas.
Yeah, absolutely. Thanks so much, Jake. We got a lot of really great symbol requests, so we have plenty to work on. I think, one of the thoughts, and again, this is going to depend on kind of stylistic preference. When I'm looking at a stock or a company that pays a dividends, I want to try to think of it in a similar way as if you owned a company or a small business, right? Let's say you were the owner of a business and you say, okay, I'm going to allow the business to run, make money, keep all its income, and then I'm going to sell it in 2 or 3 years. Or would you prefer to say, well, I'm going to allow the business to run and I'm going to take a portion of the profits and I'm going to kind of take them out of the company every year or every month for a certain period of time. Then I'm going to be looking to sell the company. And the pros and cons are going to be, okay, when you go to sell the company later, is you're taking, and I think Jake, you made this point, is you're taking all of this cash out of the company. Is it going to really hurt the company and put a burden on the company? And are you going to then go to sell it at a later time at a price that's going to be so much lower that it's not going to make sense and not going to matter that you got the income versus is the company going to hold its value or actually grow? And could you actually take the income and get some growth out of there? So really, that's the question we're going to be asking. The first example I'm going to use here is going to be Verizon. Why are we using this? It's a good illustration. They also are in the news because they reported earnings this morning. So we're going to start with this. We did get a number of different requests, which we can also use for today. So again, if you're wondering, Troy, how did you get there? Well, if you're looking at a specific company or an ETF, you can type it on the upper right-hand corner. You could also go to news and research first, and then go to stocks, and then that'll lead you to a page where you just have to type it in, and it'll take you to this page. So what I'm going to direct your attention to is there's a lot of different info. I'm going to first go to the dividends and earnings tab here on fidelity.com. What this is going to do is it's going to tell us, and again, you want to make sure the company hasn't just announced it's changing dividends and it hasn't updated here. So you want to keep in mind news flow. But the most recent data we have is that each quarter so far, Verizon has promised it's going to pay 0.6650 cents per quarter in terms of a dividend. You can multiply that by 4, divide by the current price, you would have the current dividend yield. Now, what we're looking at is how high is Verizon's dividend yielding compared to the middle stock of the market? Well, the middle stock of the market pays about 3% dividend. That means half pay more, half pay less. 6.39 is quite a bit larger than 3%. It's more than double. We're also going to look at, so you might say, okay, Verizon's paying double. That's nice. I like more income. Who wouldn't? Now you want to look at some of the risk factors. So when we invest, it's the same process when we're trading. We look at the merits, we look at the strength, we look at the opportunity, but we have to weigh them against the risks, the weaknesses, the drawbacks, the cons, etc. What are the drawbacks? What are the cons? Well, if we look at the last 12 months in terms of earnings, Verizon here it looks like is paying over 51% of its GAAP earnings. I believe this metric is using GAAP earnings. There's different measures of earnings. You could use things like cash flow. You could use EBITDA. I believe this tool here, to my knowledge, uses GAAP EPS. If you looked at not the last 12 years, but the 12 years prior, it's paying all of that out in terms of dividends. So that tells me that, okay, we had some growth in the last 12 months rather than the prior 12 months. So you got to make sure that EPS is stable, because if it's not, this is a big dividend and this company is paying out a lot of cash. That's cash that the company could be using to make acquisitions, to reinvest in the company in terms of research and development, capital expenditures, marketing, et cetera, et cetera. And they're paying that out as cash to shareholders. Now, can we look at, okay, remember we talked about current yield versus growth. How much is the yield growing? And you got to be careful that growth isn't coming from they're increasing the dividend. A yield growth can actually come if the price is going down and the dividend rate is staying stable. So, for example, Verizon has had pretty stable growth. They've had about 2% growth here. So in 2021, 2% growth. Now the market itself has been bouncing around between 2021. It had about 3% growth. It was flat in 2022. It had on average about 4% growth in 2023. So in some years, Verizon's dividend growth has outpaced the market. In some years, it's lagged. 3 out of those 4 years, it's lagged. And one of those years, it outperformed. Now, you might say it's okay to lag on the growth because I got the yield. So that's kind of something you want to keep in mind. Again, it's really hard to have your cake and eat it too in terms of getting that high current yield and the growth. That's going to be very difficult to sustain.
And
Jake, some of
specifically,
your thoughts there?
yeah, specifically, that's the growth of the dividend, which is interesting. So they already have a relatively large dividend there at Verizon. And that's why you see its line kind of shifting around there. It's grown its dividend at a nearly stable 2% per year. Whereas some of its competitors have been a little bit more sporadic, perhaps we might say. In some cases, cutting dividends, in some cases, growing them. But we can see that currently Verizon has been a pretty steady pair, although it's slightly decreasing. As you point out there, it's gone up by effectively 2% per year for the last 4 years. That's pretty stable.
Absolutely. I would 100% agree. So it's been very stable. And here's another thing. So, Jake, that's a really great kind of segue. Here's another thing we can look at in terms of just this window, in terms of looking at the rate, the current yield, the sustainability, its growth. We can also click on the More tab here, and perhaps you want a little bit more history on the company's dividends. Well, there is some additional information on dividends and earnings here. I'm going to skip some of this, and I'm going to say, let's go into dividends detail. And what this is going to do is it's going to give us about 10 years of history of a company's dividends. It doesn't go back further than that. You could use some third-party resources. We don't endorse or recommend any. But again, 10 years is a pretty decent amount of history. And what we can do is we can click View More. And this data here is split adjusted. So if a company says, hey, we did a 10-to-1 split, and you say, oh, did their dividend go down by 10%? You want to be careful that they just didn't undergo a split. And so their dividend will also reflect that 10-to-1 split. So this tool will have split adjusted dividends, which can be helpful. So if we go 10 years of history in Verizon, we can see that they actually have never cut their dividends in this 10-year period. And we can see that they have not missed a single quarter in terms of how my eye catches it here. And they were paying about 55 cents a quarter. And just like that last 4-year period we looked at, we can see here, we can look at some growth. 55 cents a quarter, 56 and a half a quarter, 57 and 3/4 a quarter, 59 cents, 60, 16 and a quarter. And you can see here every single quarter, even around COVID, they did not miss a dividend. And if you do a little bit of digging and research, you'll see that there's a number of companies around that time frame that said, hey, cash is tight, we can't pay dividends, we're going to have to miss a few. And I think that says a lot in terms of a company of saying, we're going to remain committed and keep paying the dividend schedule that we've been promising or committed to sharing with our giving to our shareholders. So again, we've had that consistent growth. So again, we can't, just because the past tells us it's been good, can we expect the same growth and the same results 10 years into the future? It's tough to say, right? We've had situations, if you looked, a couple years ago, you can look at what Verizon's balance sheet and their income statement was a couple years ago compared to their dividend, and you can say, all right, maybe their dividend is tight related to their current, GAAP income and earnings, but maybe it's been tight for years, and maybe that's not going to hurt them that much. So again, you can look at that information. You also, at a quick glance, you're not going to see 10 years of history, but I believe you're going to see, oh, what is it? Maybe about 2 years or so of dividends, maybe a little bit more there. And you can see, okay, we don't see any drop off in these blue bars. These are paid dividends. This purple bar is the current unpaid dividend, in which case we just saw their most recent announcement was in June. So they announced it goes X on July 10th. That means if you buy anywhere between now and July 9th and you hold it, you get the dividend. So it's paid out to owners of record on the 10th, and it'll hit your brokerage account around August 1st. So again, history is interesting, but we have to not only look at past history, but use that information to look forward and saying, what is our perception of risk versus reward? Does that look attractive to us in terms of where they currently reside on that spectrum there? Jake, I'd love to kind of welcome in your thoughts here.
Yeah, it looks like today being the 22nd of July. So if you buy Verizon today, you have missed the boat, right? Ex-dividend is
Correct.
passed,
Correct.
meaning if you were to buy it today, you don't get that dividend, which is fine. There's nothing wrong with that. But be aware, yep, we are not going to receive the dividend. But let's think about the consequences. What if today was July 9th? Do you want to buy Verizon today on July 9th? Why? Why not? Let's say we buy it. I'm going to buy Verizon. I have to pay $39 per share or so. We could check what the price was, but let's pretend it was $39 per share still at that point. If it was at 39, well, we would buy the stock today for 39, and then tomorrow the stock would drop by 60 some odd cents, the amount of the dividend. That's expected, and we will get that money back on August 1st when the company pays us the dividend. But when you get paid a dividend, folks, that is taxable income. Do you want your 60 cents back as a taxable earnings? I don't. There's actually a financial disincentive to buy the stock immediately prior to its dividend payout because you will receive a portion of your money back as a taxable payday. That's not what we would like to see. Instead, we want the stock to increase in value over time. And so there are some interesting nuances here to the dividend discussion. But specifically with these quarterly dividends, there is some considerations there to be had. Now, dividend taxation is an interesting world. The government doesn't want to incentivize anybody to make this financially foolish decision of buying it right before, then selling it after. But they do recognize that a long-term investor may have this taxable earnings over time, even though they are a long-term investor, and long-term investors have some preferable taxable rates. That means that qualified dividends, meaning dividends for qualifying companies, which investors own in a qualifying way, which means you have to own it for some period of time. I believe the time frame is 90 days. In other words, more than just this quarter. As long as you own it long term, then you get to pay a very low rate, a maximum of 20%, but for most people, it may even be as low as zero, the same as capital gains rate. So be aware that taxation on dividends is something of a ball of can of worms, if you will. But let's dive a little deeper into this idea here of dividends and how we might take a look at it. You've got the chart pulled up here for us, Troy. We can see that no, if you'd bought this stock a few weeks ago in time for the dividend, it would not have been at $39 per share. Unfortunately, post earnings today, Verizon is finding at least a recent low coming down to $39 per share. Anything else you'd point out to us here on the chart?
Yeah, again, this is illustrating. So this chart is just giving us price and it shows us a legend of the dividends. So this is not a cumulative chart. This is, again, just a price over time chart. I would say both in Chart Plus and an Active Trader Pro, you can do this. So regardless if you're using the trading dashboard, if you're, again, doing some of your fundamental research and you want to come here just to take a look at the chart, I'm showing the last 2 years. So we're going to see about 8 dividends in here, assuming it hasn't missed a quarter, which it hasn't. And what's nice is you can come to the events tab here. You can show dividends. And what I would encourage you all to do, just so you don't confuse yourself and spare yourself any confusion, throw the splits on there just because, again, if you're looking at a company that has split, you might think a company has decreased its dividends, and in which case, if it underwent a split, it has not. It's just the company shares are now trading lower nominally, and they're trading. There's more, shares issued and outstanding. So there's no splits here, so it doesn't really matter. But on a company that did have a split, it would matter. So what we can do is we can say, all right, where was Verizon about 2 years ago? You can see it was up here about $45 a share or so. And we can see that it's been pretty steadily declining, although recently it broke out of this downtrend. We can also see over time, hey, if we bought it about 2 years ago, we can look at all these different dates and say, hey, I've collected, and we can even count them, how many dividends we've collected since we've held the stock. And again, we'll show a little bit later, we can actually collect the dividends in cash. We can have them automatically reinvested into shares if we don't need the income and we want to kind of employ some type of compounding method where our income goes to buy more shares. If we have more shares, our dividends will be a little larger. When our dividend gets larger, we buy more shares. That can make sense as long as we have some appreciation in the stock that could magnify our principal returns. If there is a decline in the stock, that's going to magnify our losses. So in addition to doing kind of this fundamental research, and we'll do a little bit more, I'm just going to briefly go over here to Active Trader Pro, where I've done a couple drawings and saved, Jake. So I'm going to pull up Active Trader Pro. And again, if we're looking at the very short term of Verizon, you might look at this and say, okay, this just broke out of a recent downtrend. This is looking pretty good. And if you kind of fast forward to present, we can see here there's a support zone. And even after earnings, it seems like it's still around this zone. But maybe we want to go out the last 5 years. And if we do that, we can see Verizon has been in a multi-year downtrend. I'll just give my chart here a few moments to load. Looks like it did. And again, this is why context matters. If we look about, around end of November, call it beginning of December 2020, And if we draw some lower highs, we can see there was a while where it was significantly below trend. And it looks like recently it's coming back into this concept of a downtrend. So you might ask yourself, okay, we went out 2 years. Now if we went out 5 years, and if we looked at all the dividends we collected, okay, we could have bought the stock around $60 a share. It's now trading under 40. We lost $20 per share or a third of our principal investment. Folks, again, I'm not trying to pick on one company versus another. Just make sure this is the risk of dividend investing is you don't want a company to say, hey, we're going to pay out all this cash. Well, if they're paying out this cash and you're getting a declining stock price, that's not going to help you. And so it's nice to have the income. Now, could you say, well, Troy, maybe give it another couple years and it'll bounce back? Well, it can, right? And I don't have the crystal ball into the future. And so that's certainly possible, but we don't want to ignore what the price of the underlying shares are doing. We don't want to look at the income and say, this is a free lunch. I can have a high dividend. That's going to be better than a bomb. That's going to be better than anything else. There's a risk to that. And the risk is, again, the company can sometimes, many companies do this. They overpromise, they get stuck in paying a high dividend. They oftentimes don't want to cut just because of the negative perception. There can be times where there have been companies that have cut dividends, the share price has recovered, but a lot of times it's going to be viewed negatively. A lot of companies, a lot of shares tend to kind of anticipate that companies are going to have to cut dividends. Some companies will rip the Band-Aid off and do the inevitable. Some companies may continue paying even to their detriment to avoid the negative perception. So again, if you want to see dividends, even in Active Trader Pro, you can select events, click dividends. You can also show splits again if you want, if there are any splits. And of course, in 5 years, we're going to see a lot of different dividends. For a quarter, 5 years, we should see about 20 different dividends. You can add up all these different dividends, and you know, I'm gonna posit it that I think the price decline in the underlying shares has more than outweighed the income that you've received in your dividends. So again, from
I've
a
got a
total
chart
return
that
perspective,
dives into that, Troy, whenever you're ready.
yeah, absolutely. And Jake, I know you got some additional data to show on that. So let's be a little bit, we talked about the merits. Let's be a little bit more cynical now. Companies can do other things other than pay dividends. Share buybacks is a big one. So Jake, I know you got a lot of data to kind of share on that.
Well, some things were pretty attractive. We've been taking a lot of focus there on Verizon, and we'll continue to do so here for the next couple of minutes. But a lot of it has been positive enough that I might say maybe it's worth it, right? It's been moving up. It's holding on, even though it's down 6% today. It's holding on at a key area of support. Maybe it's a worthwhile purchase. But let's take a look at the long-term history. A dividend investor's worst mistake is assuming that the dividend is reason enough for the investment. And it simply is not, folks. If we were going to invest in a bond, the bond holder's reason for investing is the interest and the interest payment alone. That's all they're concerned about because there is a promise to pay. The holder will get back their principal unless a default happens, right? The company would have to go into bankruptcy in order for you to not get your money back. But that's not the case when you buy a stock. When you buy a stock, no matter how much you like it, no matter how long it's been around, no matter how successful it's been at paying dividends, there is no guarantee of what that share's price will be in the future. You looked at a 5-year chart, you looked at shorter term charts for us, Troy. This chart in front of you now, folks, goes all the way back to the year 2000. This is a long time back, 24 years worth of trading activity. And as we look back all the way here to the start of the century, what's going on? We have our white line down here at the bottom representing Verizon stock. Then the orange line is what if I reinvested my dividends over time? Again, a dividend investor often says, well, with the dividend, then it cancels out. Troy, your last 5 years started right over here, folks. And you're right, Troy. It peaked out, including dividends. And ever since late 2020, Investors in Verizon, even accounting for a 5, 6, 7, in some cases 8% dividend, have lost money. Lost money. Not made money, lost money. That's even before losing 6% today. When you invest in the stock market, there is risk, including the risk of loss. Be aware that, yes, we have done better than owning the stock alone. But take a look for me at something else. This is a chart courtesy of our friends at Bloomberg that we have a subscription to and are very pleased with the information. Take a look for me at some of these values. From the start of this chart, way back here in the year 2000, if you had bought $10,000 worth, which was 208 shares, you would have purchased them at $48 a piece, way back over here on the left-hand side. And today, they unfortunately are only worth about 39. That represents a loss of about 9%, or an annualized 0.5% loss per year. Not what you like to see from the shares and shares alone, resulting in a $1,000 loss or close to it. However, knowing that you could have received those dividends over time, and you would have if you were an owner during that entire period, well, if you had repurchased shares, you would have purchased now an additional 495 shares. And your grand total gain instead is $18,000, not losing $1,000, but on your $10,000 original investment, now walking away with almost 3 times your money, a gain of $20,000 or so. But this next line is at least as important to me. It says, what if you just had reinvested your dividends over the course of time? Not in the stock, but had bought a bond with it. Now, here it's assuming that you could reinvest at the current rate, which is probably not accurate over the course of this entire time frame. But for many of these years, for example, from 2000 up till 2008, you could get 5% pretty easily. And currently it is available yet again, though this period in the middle, it was not necessarily the case. But supposing 5% was a rate you were able to acquire during the course of this time frame, please note that you would have actually done better than investing back into the stock, walking away with an additional $1,000 in this case. So dividends are certainly part of the overall discussion, but they are far from the conclusion. We should recognize that even a receiver of dividends can and does lose money in many cases. This is in a stock that has mostly done well and is among those dividend aristocrats, very fancy in that they have always upgraded their dividend. They've increased it over time and consistently paid it. And yet, you would have lost money over the last 5 years, in some cases substantially. From 155 coming down to 100, you'd have lost 30% of your money. That's how much we're talking about in terms of losses. Not just small losses, potentially catastrophic losses. When dealing with dividends, please, folks, make sure that you ask yourself, why am I investing in it? You must have not only a dividend that you're willing to trust in, but also a positive expectation for the underlying security as well. Get the dividend along the way. Great, all the better. However, recognize that it is muddy water. There is a few other things that we might consider. Troy, before the class started, you and I were talking a little bit about the alternative, or at least the main alternative, that a company might do in order to get money back out of their accounts and to you as a shareholder, but maybe avoiding some of the issues relating to dividends, including that taxability. There was one individual, I think it was Ed, pointed out that if you own shares inside of an IRA, you're probably safe from taxation. That's probably true. There are a few notable exceptions, including those limited partnerships that we saw at the very start of the session that some of you sent in. Be aware that even in an IRA, there can be taxation with master limited partnerships and some other limited partnerships with a substance known as UBTI, the unrelated business taxable income. It's a strange part of the IRS tax code, and it means that you might pay even inside of an IRA. But assuming you're not in that particular exception, inside of an IRA, you get to avoid that. But for the vast majority of invested dollars, there is certainly the tax consequence related to dividends. So how does a corporation pay back to themselves and pay us as shareholders without that? Well, one way is what's called a share buyback. Who has heard of a share buyback out there? Has anybody heard these being announced? In recent years, they've gained popularity. Some of the largest have included Apple. So we're going to look at Apple's current buyback program. And it currently is aiming to spend up to $110 billion with a B dollars buying shares in the open market. Buying them when you want to sell shares. They're a buyer of shares. They're not obligated to do so, but they're saying, we've got the money. We're going to think about spending it on buying our own shares. You might think of this as a company saying, our stock is such a low price that we're willing to buy it with our own dollars. That's the best thing that we could possibly do with our money. Not spending it on research or development or a new product or buying a competitor. It's buying us. We're a great deal right now. Now, that's, of course, a lot of confidence coming from the board of directors and the CEO suite, but there is some interesting consequences that come along with it. For example, we can see that Apple, over the course of the last 10 years, this blue area is its stock buybacks, and this amounts to billions of dollars per year. And as we take a look, it dwarfs its other costs. It's paid dividends, yes, $15 billion worth, but it has $110 billion set aside for these buybacks. So instead of paying large dividends, they've instead opted to do something else. In the old days, for example, many of you may have read the famed book by Mr. Benjamin Graham, The Intelligent Investor. The Intelligent Investor is advised to seek out companies with high dividends and solid fundamentals, as this will tend to lead to a positive investment value in the future. That was then the thesis of the book. However, that was before share buybacks existed, and certainly way before they proliferated and become one of the largest ways that corporations return money. A company today does not necessarily need to pay a dividend in order to be a good and solid investment. But think about it 50 or 100 years ago. 100 years ago, a company that could afford to pay a dividend and could afford to pay it every quarter, and every quarter could increase the size of that dividend, was a healthy financial company. And a healthy financial company tends to generate positive investment returns for us as investors. But do you see that was a couple of lines in between that we had to get to between payer of dividends and investor makes money? It wasn't the dividend payment that brought us the money. It was the company being a good, positive, financially stable company with growth opportunities, able to pay a dividend. That's what was involved here. And so a company like Apple, which pays a tiny dividend, a company like Amazon that pays no dividend, a company like Nvidia that pays a token 1 penny dividend, does not necessarily have to get ruled out. If the other dots align, an intelligent investor might still consider those worthwhile investments when taken in holistic view of why an investor may consider it. So, my closing advice to you folks as we wrap up the session is to view dividends as one positive sign that a company is healthy financially. But we saw that in some cases, for example, by observing their payout ratio, they may be using a little sleight of hand to make it look like they're financially attractive. A dividend payer does not guarantee profits to us as investors. Rather, they are returning some of their own money, some of those earnings, some of our invested dollars back to us, potentially in a taxable way. That is at least a possible negative. And there are other ways for companies to return capital to investors, including share buybacks, which have grown in huge ways. Just notice for me that the $110 billion Apple has set aside, there's an interesting trend here. Do you notice how there's no big blue bar in the month of April or May or June or so far in July? And the shares of Apple have gone up and up and up and up. While the shares were low and depressed, Apple was buying back its shares en masse, millions of shares at a time. But in the last couple months, Apple is no longer running around with that flag that says the best thing we could possibly do with $110 billion is buy more Apple. It doesn't mean that they won't, but it is an interesting point that currently they seem to have not acted on this opportunity to buy more of their own shares. They do have an outstanding ability to buy 3% of the entire value of Apple. That's a lot of money. There is a potential buyer in the woods for Apple that may support the price if the price comes down, and that buyer's name is Tim Cook and everyone there at Apple. So be aware that there is some interesting things that we should be aware of beyond the face value dividend payment. So Troy, we're already 2 minutes past. Let me go ahead and pass it over to you for your last closing thoughts here.
Yeah, folks, I would say don't throw the baby out with the bathwater, right? We want to present both sides of the equation. We want to be fair. We want to present the pros and the cons. You have to find that balance, right? Depending on your goals, depending on your outlook, dividends is something you should factor in. I would say it probably is prudent not to seek dividends alone because in many cases there can be companies that will pay a high dividend. However, their share price can decline, especially if they're in a heavy headwind type business where business is slowing. Sometimes companies will pay, as Jake mentioned, a heavy dividend to entice investors because perhaps they don't have the growth to attract investors. So sometimes it's okay, you're getting a dividend, but you're getting declining growth. Again, always look at the risk and the reward. There's ETFs, there's mutual funds that will have a diversified portfolio of companies that pay dividends and will apply certain metrics. That could be a good way of gaining a broad-based exposure, whether you're using an index or perhaps an active manager. Fidelity has many different products and services available. If you want to talk to an advisor and have a managed program, that's something you could consider. But the idea is if you're self-directed, which is what our team educates coaches to, and you're seeking out dividends, always consider the risk factors. It is not a free lunch. There are risks involved. And as always, as traders, we get rewarded by evaluating and identifying opportunity and weighing the risks and trying to have a situation where we have a higher risk adjusted rate of return. Thanks so much for joining us. We hope to see you again in a coming session in the near future. If you haven't already, go to fidelity.com/coaching. You'll see many of our different sessions and many of our different topics. We hope to see you in another session again soon. Jake, thanks so much for sharing your data and your perspectives there. Always a pleasure. Take care, everyone.